Impairment of assets. Where did we say that? Where did we say that? An asset is said to be impaired. 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 If the carrying amount, an asset is said to be impaired if the carrying amount exceeds recoverable amount. If the carrying amount exceeds recoverable amount. An asset is said to be impaired if the carrying amount exceeds recoverable amount. Let's define carrying amount. Define carrying amount. Carrying amount is the amount of an item. Is the amount of an item recognized in the financial statement. Is the amount of an item recognized in the financial statement. Recognized in the financial statement. Recognized in the financial statement. Let's define recoverable amount. Recoverable amount. Let me see that. This is the higher of. This is the higher of, semicolon. This is the higher of, semicolon. A, fair value less cost to sell. B, value in use. That recoverable amount is the higher of. Is the higher of. Number one is the fair value less cost to sell. And number two we have is the value in use. Let's define value in use. Define value in use. You see that? This is the present value. This is the present value of the future cash flows. This is the present value of the future cash flow of the remaining service potential. 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 Of the asset, of the remaining service potential of the asset, of the remaining service potential of the assets. Good. Terminologies. Number one, cash generating asset. Cash generating asset. Let me say that. This is an asset held. This is an asset held. This is an asset held to earn commercial returns. This is an asset held to earn commercial return. This is an asset held to earn commercial returns. To earn commercial returns. Number two, cash generating units, CGU, cash generating units. Let me see that. This is a group. This is a group of identifiable assets. This is a group of identifiable assets held with an objective of generating commercial return. Held with an objective of generating commercial returns. Held with an objective of generating commercial returns. I repeat again, we're saying that a CGU is a group of identifiable assets held with an objective of generating what? Good. Then let me say that still under CGU. In case of an impairment loss of a CGU, in case of an impairment loss, in case of an impairment loss of a CGU, in case of an impairment loss of a CGU, comma, allocation of the impairment loss, allocation of the impairment loss, allocation of the impairment loss shall be as follows. Allocation of impairment loss shall be as follows. Allocation of the impairment loss shall be as follows. Semicolon. Number one. First, reduce any carrying amount of goodwill. First, reduce any carrying amount. First, reduce any carrying amount of goodwill in bracket. First, reduce any amount of goodwill in bracket. Write off the goodwill. You write off the goodwill. I'll say that number one. First, reduce any carrying amount of the goodwill in bracket. You write off the goodwill. Number two. Allocate the balance of the impairment loss. Allocate the balance of the impairment loss. Allocate the balance of the impairment loss to the other non-current asset, of the CGU. Allocate the balance to the other non-current assets of the CGU in proportion to the carrying amount. In proportion to the carrying amount. Terminology number 3, non-cash generating asset. Non-cash generating asset. Right? This is an asset. Other than cash generating, this is an asset other than cash generating asset. This is an asset other than cash generating asset. In bracket, government assets. It's as simple as that. So what's depreciation? Impairment. Depreciation is not impairment, but they have some similarities. When you talk about depreciation, what do you understand by the word depreciation? A loss of value. Okay, what about amortization? Amortization is for intangible asset. That's correct. So amortization is the loss of value of intangible asset. Depreciation is the loss of value of tangible asset. What about impairment? Impairment and depreciation are not the same. Are you together? Yeah. Now take a scenario. For example, if you have a machine, or for example, you have a vehicle worth 3 million. Now that's the cost, and you have been with this asset for 1 year. Then during the year, you charged a depreciation of 500. That was depreciation charge for the year. So how much is the carrying amount or the net book value? The amount of 25. Now this net book value is what we call the carrying amount. That means the amount shown in the financial statement is 25. Now, assume you want to sell that vehicle now, and you know its value is 2,500. But the maximum you can get, or the highest bidder, is only giving you an offer of 1.8. But you know the value is how much? 2.5. There is a loss by how much? Now that 700 is what we call the impairment. If you buy a new phone now, today, worth 100,000, can you sell it today at 100,000? No. The value automatically reduces, right? Now that's not depreciation because number one, you have not used the phone. Depreciation is a result of the usage. But in this case, the value has just reduced. Now that loss of value is what you call the impairment. So you're saying that, can you go back to the definition? Go back to the definition, it says that an asset is said to be impaired when the carrying amount, now this is the carrying amount, exceeds the recoverable amount, exceeds the recoverable amount, the maximum you can recover now from the market. And what is carrying amount? Is an amount of an item shown in the financial statement. What about recoverable amount? What is the recoverable amount? Is the higher of. Yeah, recoverable amount is the higher of. Is the higher of. Number one, the fair value less cost to sell. If you are to sell now, how much do you fetch from the market? You less any net selling cost. Also, you compare against the value in use. What is value in use? Just look what you have written. Is the present value of the future cash flow of the remaining service potential of the asset. Now, in this case, now you are making one decision. This my asset is worth 2.5. The highest bidder is giving you 1.8. What if I don't sell it now? I use for the next 3 years. How much benefit will it generate? Now, that's what you call the value in use. The present value of the expected cash flow for the remaining service potential of the asset. Now, let's look at indicators of impairment loss. Indicators of impairment loss. Indicators of impairment loss. Let's start with external indicators. External indicators. External indicators. Because what happens at the end of each financial year, the company will have to assess whether its assets have been impaired. And in case of impairment loss is an expense. So you take it to the income statement. So number one, under external indicators, number one, significant decrease in market value of the asset. Significant decrease in the market value of the asset. Yeah, when the market value of that asset declines. So that's one of the indicators that your asset has been impaired. Number two, significant changes with adverse effects. Significant changes with adverse effect on the entity's assets. Significant changes with adverse means negative, with adverse effect on the entity's asset, such as change in registration, not registration. I mean this, registration. Change in registration, not registration, registration, area. Another one, technological advancement, etc. Yeah, actually, whenever there is technological advancement, if you buy something now, and then after 2 months, there is another model which is more advanced. So automatically, your asset will not be that marketable as compared to the more advanced one. Another one, number 3, another indicator. Significant increase in the market interest rate. Significant increase in the market interest rate. Significant increase in the market interest rate. And those changes and those changes are likely to affect, the discounting rate, the discounting rate used in determining the value in use. Read that statement again. So what do you understand by that statement? Increase in the market. Now, how does the increase affect? Now, assume that you have an asset worth 1 million. Now, what is value in use? Is the present value of the future expected what? Benefit. Now, in this case, we want to determine now recoverable amount. I will say that recoverable amount is the higher of, number one, the value in use, less cost to sell. I mean, the fair value less cost to sell, or the value in use. And you say that to get the value in use is the present value. So assume the cost of capital or the interest rate is 10%, and the value is 1 million. You expect 1 million at the end of the first financial year. So how much is the present value now? So just rediscount. Present value interest factor, 10% year one. 1,000, this is 0.1991. How much is that? It's not there. This is financial reporting, not financial management. Yes? You not be given the table. 1990. Now, what will happen if now the interest rate increases? If the interest rate increases, now instead of 10%, now let's work with 15%. The same value of 1 million expected at the end of year one, but now the rate is how much? 15%. Give me 15%. Use your calculator. I gave you the formula. How do you get the present value? 1 plus r raised power negative n. Now you know. You get 0.8? 869? None is the exempted FM here. Or there is someone not doing FM? Oh, you cannot be exempted that. So how much will be the value now? 86.90. Now what has happened? When the rate increases, what has happened to the value? The value reduces. Yeah. See, in that case, that's one of the indicators of impairment rules. Good. Now let's look at internal indicators. Internal indicators. Now, what are some of the internal indicators of an impairment loss? Number one, physical damage of the asset. Physical damage of the asset. Number two, evidence of internal inefficiency. Yeah, that means the asset is not performing as how you expected. Good. So that are some of the indicators of impairment loss. Then you like to see that. And NB. Impairment loss is recognized immediately. To P&L account or to income statement. It's recognized immediately to P&L or income statement as an expense. Good. Now let's look at impairment reversal. Subheading. Impairment reversal. Yeah, what's an impairment reversal? Here you have an asset which has been impaired, but now it starts to regain back its value. That's what you call impairment reversal. So when you're also assessing for the impairment loss, you also need to assess for the impairment reversal. Would you like to see that? An entity shall assess. An entity shall assess at the end of each reporting period. An entity shall assess at the end of each reporting period. At the end of each reporting period, whether there is any indication, whether there is any indication, whether there is any indication that an impairment loss recognized, whether there is an indication that an impairment loss recognized, an impairment loss recognized in prior period, impairment loss recognized in prior period. I've said that an entity shall assess at the end of each reporting period whether there is any indication that an impairment loss recognized in prior period for assets other than goodwill, for assets other than goodwill, for assets other than goodwill may no longer exist, may no longer exist, may no longer exist, may no longer exist. That means the impairment loss recognized, you assess whether it has disappeared. That means in case it has disappeared, that means it's an impairment reversal. Now let's look at indicators of impairment reversal. Indicators of impairment reversal. Indicators of impairment reversal. Actually, it's the opposite of indicators of impairment loss. What was the first indicator of impairment loss? Significant reduction in the market value. So for impairment reversal, that's right. Significant increase. Significant increase in the market value of the asset. Significant increase in the market value of the assets. Number two, significant changes with favorable effect, significant changes with favorable effect to the entity's asset. I've said that significant changes with favorable effect to the entity's asset, Yeah, in this case, the other one was adverse changes. Now, in this case, it's favorable changes. Another one. Reduction in the market interest rate. 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 Another one. Evidence of superior effectiveness. Evidence of superior effectiveness. Evidence of superior effectiveness. So now that means the asset now has been started to perform better than how it was performing before. Good. Now let's look at limit of impairment reversal. Limit of impairment reversal. Limit of impairment reversal. Right, we say that? The increased amount of an asset other than goodwill, the increased amount of an asset other than goodwill, attributable to a reversal, the increased amount of an asset other than the goodwill, attributable to impairment reversal, sorry, attributable to a reversal of an impairment loss, attributable to a reversal of an impairment loss, attributable to a reversal of an impairment loss, shall not exceed the carrying amount, that would have been determined, had no impairment loss recognized in prior period, recognized in prior period. Another sentence, let me see that, another sentence. Any increase in the carrying amount, of an asset other than goodwill, any increase in the carrying amount of an asset, other than goodwill, above the carrying amount, that would have been determined, had no impairment loss recognized, in prior period, is a revaluation. Good. Then let me say that impairment reversal will be recognized as an income to P&L account. Impairment reversal shall be recognized as an income, to P&L account. I want to give you time. You go through that impairment reversal, limit of impairment reversal, because I'm sure you didn't understand what you have written. Just go through it and try to interpret. What have you understood? Limit of impairment reversal. What have you understood? Now, if you have an asset whose the carrying amount is 25, that was the carrying amount. And then I'm using the illustration I've given you to explain what was the impairment loss. Then the recoverable amount, the maximum you can recover is 1,800. That means you are recognized an impairment loss of how much? Impairment loss of 700. So how much amount will you show now to the financial statement? So the new carrying amount to be shown now in the financial statement, it is 2,500. You minus the impairment loss of 7, of which you get 18. Now this is the amount that will go to the financial statement, 1.8, because the 700 you recognize to the income statement as a what? As an expense. Then after 3 months, the value shoots. Reversal is how much? So there is a balance of how much? What is this 200? Can you consult your notes again? That was the last sentence you wrote. That's what you call a revaluation. A revaluation. Good. No, that's a revaluation. The 700 is what you take it to the income statement as an income, impairment reversal. The 200 is part of revaluation reserve. Take out your past handout. Handout question 1, page 1. Sorry? Revaluation goes to the revaluation reserve. Handout question 1, page 1. Handout question 1, page 1. Let's do that question. And then kindly, for the honest student, kindly ignore the chat box. Just concentrate on the class. Ignore the chat box. There is a scammer there trying to send other links and some inappropriate materials. But the good thing that one goes to the chat. Just ignore that. Question number 1. ABC Limited owns a manufacturing plant with a carrying amount of 74.90. So now that's the carrying amount, the amount shown in the financial statement. The government has just imposed an export quota on the product manufactured by the plant. Following this development, ABC Limited has prepared the following estimate of cash flow from the usage of the plant over the next 5 years. So we're given year 1 to year 5. We have the cash flows. Then we have the present value interest factor at 15%. The plant can be sold currently at 5.6. Now that's what we call the market value or the fair value. The plant can be sold currently for 5.6. Selling cost would amount to 100,000. The cost of capital is 15%. Required recoverable amount of the plant. Can you go back to the definition? What's recoverable amount? Good. Recoverable amount is the higher of. Number 1, the fair value less cost to sell and the value in use. You are told that the last paragraph, the plant can be sold currently at 5.6. Selling cost would amount to 100,000. So can be sold at 5.6, but the selling cost would amount to 100. So how much will be the net selling cost? 5.5. Then you compare against the value in use. What is the value in use? We said what is value in use? The present value of the future expected cash flow. So we have been told that ABC Limited has prepared the following estimate of cash flow from the usage of the plant over the next 5 years. If you choose this asset for the next 5 years, they have given the estimated cash flow to be generated. So we have here 1, 2, 3, 4, 5. Then we have the cash flows. We have 2,300, 2110, 1570. We have 1040, 2330. Then to get the present value, are given the discounting value. Present value interest factor, 15% year end. Year 1, we have it 0.8696, 0.7561, 6572. We have 5717, 4972. Now let's get the present value. Let's get the present values. Yeah. The first one is 2,000. Year 4 is? Sorry? 595. 1158. 1595. Year 3? We have 10, that one. Now let's add the total present value. Add the total present value. Sorry, 16? 6380. Good. So now recoverable amount is the higher of the two. So how much will be our recoverable amount? $63.80. Number 2 of the question. Impairment loss of the plant. How do you get the impairment loss? Now let's go back to the definition. We see that an asset is said to be impaired when the carrying amount exceeds the recoverable amount. How much is the carrying amount? We have an amount of 74.90. How much is the recoverable amount? 63.80. That's how we get our impairment loss. 1110. Now this 1110, you'll take it to P&L as an expense. Now, how much do you show now to the financial statement as a new carrying amount? Now, the new carrying amount, you see the carrying amount was 74.90, But now you have recognized an impairment loss of how much? 1110. So you'll get an amount of 63.80. Yeah, the recoverable amount is what now you show to the financial statement after recognizing the impairment loss. You can copy now. Let's do question number 2. Question number 2. Question number 2 of the handout. Number 2, I told that. Now, this is a question on a CGU in case of a cash generating assets where you have more than one asset. So how do you allocate the impairment loss? So you're told that Q Limited has 3 operations based on 3 countries, each of which represent a cash generating asset. On purchase, the data of country A were allocation of the purchase price of 6 million. That's 6 million, that's the purchase price, of which the fair value of identifiable asset was 4 million, goodwill 2 million. So the value of identifiable asset, identifiable asset, the same as non-current assets, was 4 million and goodwill 2 million. And the total we have is 6. So now that was the cost. Then you're told that depreciation is charged on a certain basis over 20 years with no residual value. So that means for us to get the carrying amount, you see, how do you get the carrying amount of net value? Is the cost, you deduct any amount of depreciation, and that's how you get the carrying amount. Carrying amount. And we are told that depreciation is charged on a certain basis over 20 years with no residual value. At the beginning of year 4, so that means we are doing the impairment assessment after 4 years. At the beginning of year 4, there had no impairment of goodwill arising on acquisition. So that means goodwill has not yet been impaired. If the goodwill has not been impaired at year 4, how much is the carrying amount? So depreciation is 0 or impairment is 0. So the carrying amount will still to be 2,000, has not been yet impaired. To that, at the beginning of year 4, they had no impairment of goodwill arising on acquisition. At the end of year 4, can you underline that? At the end of year 4. So now you're reporting at the end of year 4. At the end of year 4, the government export restriction was introduced. So now the question is, at the end of year 4, since you are depreciating the asset on a certain over 20 years, how much was the depreciation? So depreciation, remember goodwill was not impaired. So the carrying amount is made to be, or the value will still remain to be how much? 2 million. What about the identifiable asset? It's 4 million. We have to depreciate over 20 years. You get depreciation per annum, but now you're assessing after 4 years. So at the date of assessment, how much was the accumulated depreciation? 800, Yeah, the accumulated depreciation will be 800. So therefore, to get the carrying amount, the cost was 4 million. You less depreciation of 800, it will get an amount of that too. So that means at the date of assessment, the total assets of the CG was an amount of 5,200. Good. We repeat that again. We have that. At the end of year 4, the government export restriction was introduced. The fair value less cost to sell. Fair value less cost to sell for the operation of the country A cannot be estimated since a buyer could not be found. Fair value less cost to sell. So how do you get the recoverable amount? We say that recoverable amount is the higher of. Number 1 is the fair value, less cost to sell, and the value in use. We read that statement again. We are told that. The fair value less cost to sell for the operation of country A cannot be estimated since a buyer could not be found. So how much is the fair value less cost to sell? Unknown. It's 0. Since a buyer could not be found. You see, if you cannot find a buyer, can you sell? You cannot sell, eh? So that means the fair value less cost to sell is 0. You cannot find a buyer. Eh? So that means the fair value less cost to sell is 0. Then after that, the value in use is calculated at 2.73. So we're given the value in use, 2.730. Now let's get the recoverable amount. How much is the recoverable amount? $27.30. The higher of. So therefore, you can be able to identify the impairment loss. How do you get the impairment loss? An asset is said to be impaired if the carrying amount exceeds the recoverable amount. And you already have the carrying amount. The carrying amount at the date of assessment was an amount of 52. But as per now, the maximum you can recover is how much? 27.30. That's the maximum you can recover. So that's what we call the recoverable amount. That means there was an impairment loss of how much? Amount of 24? Yeah, 24.7. That's the impairment loss. Now let's go to the required. Calculate the impairment loss. We have it 24.70 and state how it should be allocated to the assets of country A and state how it should be allocated. Now let's go back to the second definition. Cash generating unit. Cash generating unit. There is a statement I gave you that in case of an impairment loss of a CGU, the impairment loss shall be allocated as follows. Number one was what? First, you reduce any carrying amount of what? Goodwill. In bracket, you do what? You write off the goodwill. Then number two. Good. You allocate the balance to the other non-current asset of the CGU in their proportion to their carrying amount. Yeah, so in this case, remember in this case, we don't have only one asset. We have several assets. We have identifiable asset, we have the goodwill. If you have more than one asset, that's what we call a CGU, cash generating asset. So how do you allocate impairment loss? So we have the assets, we have identifiable assets, and then we have the goodwill. Then we have the carrying amount. Now, the carrying amount at the date of assessment was that 2. Goodwill was an amount of 2, and the total was 52. But now we need to charge an impairment loss of 24.7. Now the question is, how do we allocate? So impairment loss. So the total impairment loss was an amount of 24.7. In case of a CGU, how do we allocate? We have said that number one, first of all, reduce any carrying amount of the goodwill. In short, you write off the goodwill. The goodwill value was an amount of how much? 2,000. How much the balance of impairment loss? 470. Now the 470 is what now you allocate to other identifiable assets. Now let's get the new carrying amount now to be shown in the financial statement. That 2 minus 470, you get 27.30. Good. 27.30. You write off the goodwill. 2 million minus 2 million? 0. How much is the total? 27,000. Yeah, which is the same as, you see the carrying amount was 52. If you raise the impairment loss of 24.70, it will get an amount of 27. That amount to be shown in the financial statement. You can copy. Let's do another one. August 2022. August 2022. Question 2A. Question 2A. August 2022, question 2A. Can you read that question? Can you do it? Can you do it? Let me give you 3 minutes. Just compute for me the impairment loss. August 2022, question 2A. Impairment loss should be through by now. What are you getting? I remember I'd given you question 2, part B. The one for income tax. But we did it in class. Ile hamkuwa mnashikanisha kitu on Sunday. Can you imagine question 2A? That was the easiest question of that sitting. And about of Japata impairment loss. That was the easiest question that sitting. 16,400, eh? Yeah, should be something like that. This question you should only spend, but that one does not mean, Maureen, that you have 10 marks. Eh? That one you only have 4 marks. Eh? Only 4 marks. Now let's do it. Let's do it. B Limited operates a factory as its sole cash generating unit, CGU. During the year ended 30th of April 2022, there was an explosion in the factory, which necessitated an impairment review. The carrying amount of the factory assets was as follows. We have the goodwill, patent, machinery, computer, premises. How much is the carrying amount? 7,600. Yeah. Others even didn't notice. They already given the carrying amount. So you know that the carrying amount of the factory asset was as follows. It was an amount of 47,600. To get the impairment loss, you compare the carrying amount against the recoverable amount. And recoverable amount is the higher of. Number 1, fair value less cost to sell. Less cost to sell, or what we call the net selling cost, and the value in use. Additional information number 1. An impairment review revealed that a net selling price of 19.2 million and a value in use of that one, 200. The net selling cost, that's the fair value less cost to sell, 19,200, and value in use of that one, 200. How much the recoverable amount? The higher of an amount of that one, 200. So the recoverable amount, the maximum you can recover is that one, 200. And the carrying amount was 7. So that means there was an impairment. So an amount of 16,400. This is the amount to be shown to the financial statement. Number 2, half of the machinery have been destroyed and have no resale value. The patent have been superseded and are now considered worthless. The company follows the cost model as permitted by IAS 16. Yeah, that's PPE. IAS 16 is for PPE. Property, plant, and equipment required. Discuss with suitable calculation how any impairment loss, in this case, we have gotten the impairment loss of 16,400. How the impairment loss in the CGU would be accounted or allocated in accordance with IAS 36, impairment of asset. How do you account for this impairment loss? You are told that in relation to CGU, cash generating what? Unit. This is a group of assets. Eh? So how do you allocate? It's all about allocation. We have the asset. And for the assets, we have goodwill. We have patents. We have machinery. And for the machinery, we have the one which are fully impaired. Then we have others. Then we have computer equipment. And then we have premises. Then you are given their carrying amount. For the carrying amount, goodwill was an amount of Yeah, was an amount of 2,000. Patent was an amount of 36. Then machinery was an amount of 4. But you do that for the machinery. Let's go to note number 2. Half of the machinery have been destroyed and have no resale. That means they have to be written off. So they have been fully impaired. Half of the 4,000. How much is half? So what about the other machinery? 2,000. The total, remember, was 4. Half was fully impaired. They to be written off. Then we have computer equipment was an amount of 8. And then we have premises an amount of that. And we have the total is an amount of 47,600. Now let's allocate the impairment loss. How much was the impairment loss? Impairment loss. Impairment loss was an amount of 16,400. How do we allocate? Let's go back on how we allocate. In case of CGU, number one, we said you do what? You write off any amount of what? Goodwill. We had goodwill. The value was 2. So you write off goodwill. So that now we get the new carrying amount. And then you have been told that, let's go to note number 3. The patent have been superseded and are now considered what? Worthless. So that means you need to do what? You write off. So patent, you write it off, 36. So that this is 0, this is 0. Of the machinery, half were fully impaired. They were to be written off. You don't expect to recover the amount. So you write it off. So how much will be the value? 0. Now, how much is the balance? Can you go number 2? How do you allocate? In case of CGU, how do you allocate? Number 1, first of all, you write the amount of goodwill. Number 2, you allocate the balance of the impairment loss to the other non-current asset of the CGU in the proportion to their carrying amount. So how much is the balance of impairment loss? Let's be here. Of impairment loss. It was an amount of 16,400. You minus 2,000. You minus 36. You minus 2,000. How much was the balance? 800. Now, this is now what you need now to allocate to the other assets in the proportion to their carrying amount. So we have machinery. We have computers. And then we have premises. Yeah, they are carrying amount. So we have 2. Computer, you have an amount of 8. And then premises an amount of 30. And the total is an amount of, is it 40? Yes. Then we are allocating that proportion. Remember, the balance is 8. For example, here you take 2 over 40. You multiply by 800. 8 over 40. You multiply by 800. 30 over 40. You multiply by 800. 3 over 4 is 3/4. 3/4, that is 66, right? 440, eh? What about this? 440 times 4. 880, that is 1760, right? 1760. So that means to other machinery, you allocate an amount of 440. Computers, 1760. Then premises an amount of 66. So now give me the new carrying amount. This one will be 1560, right? This one will be 6240. And this one will be 23,400, right? Come on, 2 years, eh? Give me that. You get an amount of that one? Of which this is the new carrying amount. Will cover. Remember, the carrying amount was 47,600. You raise the impairment loss of 16,400. You get an amount of that one. That's how you do the allocation. And that's how you're getting your 10 marks. So you can copy. And then we can, we still have time, eh? Or we call it a day. We can call it a day. I'm also tired. But I can change my mind, I come back. Eh?